it's difficult for central banks at the moment because they know that there's going to be a negative growth impact from the war in Russia, Ukraine, but they equally know there's going to be less supply. There's going to be an inflation impact as well, and that's probably going to be much bigger. And inflation was already high, so they have to go on a path to hiking rates, really, just in order to combat that inflation effect. So I think from a portfolio perspective, what we're seeing is a bit of rotation out of bonds into equities. I think that makes a lot of sense, particularly equities that perhaps can weather this storm in terms of weaker growth.
Sharon, is there a risk that the Fed's wrong again? I mean, we had, of course, a lot of commentators concerned about inflation. The Fed thought it would be managed, it would just flip back lower. Then, of course, we had a further increase in commodity prices, which has left the Fed wrong-footed. But if they can't judge some of the variables now around the pandemic, why do we think that they can judge the geopolitics around Russia, Ukraine?
I mean, all central banks will say they're data dependent, so they can give you a path of what they're expecting. And the Fed hike last night was quite hawkish in many ways. They said that they would be planning to raise rates every single meeting from here. But clearly that does depend on the data. If the war worsens, if the economic impact is bigger in terms of growth, then they will probably have to reduce the number of hikes. But then again, if the inflation impact is higher, then they will have to increase them. I mean, it's possible. It's not our view, but it's certainly possible that you get one of their hikes being 50 basis points. So I think there is a lot of uncertainty, which is why there's so much volatility in markets at the moment.